Welcome back, everyone. I hope you have all been doing well. It has been a while, but today's video is going to be a few thoughts about markets in general and about where we may go next, what I'm kind of thinking, how I'm looking at the market right now. Because there's a lot of uncertainty and a lot of different things that could happen, but I'm just going to try and give an overview of how I'm thinking about it and kind of the 30,000 foot view, if you will. I have to admit, I was pretty hesitant to release and to narrate this video. I had put it together a while ago, but I felt that the move up had been so sharp that I didn't really want to um, at all sound bullish. And some of the things later in this video kind of point to a bullish overtone, and you'll see what that is in a sec. But it was uncomfortable to sound that because I thought, okay, people are bullish. People are bullish. The price is going up, and maybe people might be a bit too bullish. So I didn't really want to release that on top of what I saw as I thinking people were bullish. But the fact is, I didn't really check the sentiment indicators for a while, and then like a few days ago, I saw a sentiment survey, and I was really surprised because normally when the price is moving up, people tend to get more bullish, and when the price is moving down, people tend to get more bearish. Here, the price was moving up, and still we were at 24.9% bulls and 50% bears. I was surprised. And I was surprised because of a number of dynamics that I'll get to later in this video. I kind of wanted to start by pointing out that anyone, especially myself, when we're predicting something or guessing at something, it is just that. It's a guess. And there's can be high probability guesses and low probability guesses. And the thing about a lot of uncertainty is nobody knows. So as for markets in general, I think there's a 40% chance, let's call it, that we don't make a meaningful move lower and or test the lows or anything. So there's no like sharp move lower and then recovery. It's just kind of slow grind recovery or some type of recovery. I think I'm saying maybe 30% chance that we fake out, pull back and meaningfully and maybe test a low, maybe slightly lower, maybe something like that. And the remaining 30%, I have it at go lower. Now, obviously, this is very kind of broad and it's very uncertain, but that's kind of how we're living. That said, even though I thought that we may well go lower or that it's possible that the bottom was not in, I started doing, well, what I said I was going to do. In previous videos, I said I was looking for when the VIX stopped going up and started going down to buy. Tried to nibble beforehand a few times, didn't really work out great. But when it stopped going up, it kind of plateaued for a little bit, started going down, I started buying. Could it go lower? Absolutely. But this is how I framed it in my mind. And if you look back at history, in '08, late '08, there was a huge VIX spike, huge crash. It went lower in '09, stock market, yes, went lower. But 1 year after the big end of the VIX spike in '08, the market was higher than um, where it was when the VIX peaked. So my thought was for the long term, VIX peak probably won't hurt to nibble. That said, anything can happen and every market's different. For example, in the 2000s, in the dot-com mania, the general market made its lows in '02, '03. However, commodities, for example, some bottomed in '99, some bottomed in 2000. I mean, depends on which which commodity you're talking about. So different things kind of come and go, roll at different times. Every time's different, but buying panic, and by panic I'm saying VIX of, I don't know, felt like 100, but probably was closer to 80, 85. I can't remember. Feels like a lifetime ago. Last month. You know, often is something to do for the long term. Prior videos, another thing I said was that I thought that the bottom would be well before things got better. Why did I think that? I thought that because you get to a point where how much worse can you get? And it kind of getting worse kind of slows down before you start getting better. So like the rate at which things get very bad, that slows. And then you could kind of look at it like from the long term, where's it going next? And the market tends to be forward looking and predicts things. That said, I thought the bottom would be in mid to late April. And so that's looking wrong. But it's hard to predict when you're looking at, well, predicting is hard enough. Predicting what people are going to think about predictions and who's going to predict what you're predicting before you predicted it, that's just a headache to think about. So you never know what people are looking at. If some people are looking at the jobs reports, well, how much worse is that going to get? I don't know. I don't think it's getting much worse. Um, how much worse is the virus situation going to go? Again, who knows? But we know that eventually the economy is going to have to be put back together and things are going to have to start restarting. I don't know if that's soon or later or whatever, but things will have to get going. And day by day, we get closer to a day where, how many people are working on a vaccine? I don't know, a lot, probably. So we get closer to that. We get closer to when the economy opens day by day. And so time is going to heal all wounds when it comes to the market. Now, can it go absolutely much lower first? Who knows, maybe. But eventually, time is on the side of, time will be on the side of the bulls. For now, I guess one could argue that it's on the side of the bears because most things are closed, but that can't last. As far as price goes, some people are saying, oh, look how much things have fallen, look how cheap things are. Well, others will point to the fact that we've barely fallen and, things are expensive because next year's earnings are going to be bad or non-existent or something. And I'll get more to the looking at forward earnings picture in a second, but we've gone from the way I think about what's happened in the past month and a half really, is we've gone from long-term kind of cheap on certain things to short-term very expensive on certain things. And it really depends from stock to stock, market to market, company to company. It really depends. So there's no blanket statements here for everything's expensive or everything's cheap. That's just more, more research is needed. What have I done in the past month and a half? Well, I've been doing a lot of different things, but not many things. I haven't been like going all in many different, well, anything really, but I've been doing a number of things. One of the things I've done is I've taken this opportunity to put some cash into the buy and forget type category. For me, when I saw utilities that had fallen precipitously and REITs, certain REITs, I just looked at it and it didn't make sense to me because we entered a lower rate environment. You know, Stimulus coming from everywhere and endless monies being created. And then you have these assets that are bond proxies, whereas bonds yield nothing. And they're inflation hedged, and I'll get more to this in a second, but central banks are going to do everything they can to fight deflation. I don't know. It seems like the type of thing that you type of opportunity for when you might want to buy that type of thing. So I bought a little. And the other thing, I've started nibbling on a few economy focused cyclicals, and I pointed to some in the previous video, so I'm not going to go through a whole list, but the traditional cyclicals, if you will. I've been looking at those because they well, they peaked a few years ago now. They weren't even at their highs last year. Some peaked in 17, some peaked in 18, and some are down still 70%, 75% from their highs. And some of these are good companies, and they've just fallen with the economy. And once it recovers, good companies. Okay, so I am redoing this because last time the audio came a bit messed up. So oil has been a headache that I did want to address because there's been such political nonsense and the game is so political at this point. It's difficult to read because there's been shut-ins in different places and the market's been a bit of a mess. That said, if if the free market and the pricing power needs to dictate what needs to be done, then I would think that the price of oil is going to go lower from here because to stimulate the shutdown, if you will, of existing production, price needs to be in the teens. That said, it did tick in the teens briefly, but now it's above that. So if the price persists here, it might take longer for the shut-ins. And oil has been very annoying because the longer that price stays higher, the more storage that gets filled, the more time it takes to recover on the other side. That said, the rig count is declining massively, so we will see declines in the future. But for now, the prices still may go lower. They absolutely won't stay this low forever. They need to go higher if we're ever going to see more production. I saw someone say something that I found kind of comical. They said that we may not, they don't know if we'd ever see oil prices above 65 ever again. I think that's crazy. I mean, we're probably going to see them within 5 years. That said, I don't know how many of the companies that are around today will be around and in what form at that point, especially if this takes longer. And there's been it's a big mess right now, oil. And so the market works naturally. Again, I think we might see a bit lower, but it can't stay here forever. It's just very hard to read here. Don't really want to go too much into this, but some quick virus thoughts. It's really a tough call what we should do. I know with certainty that we can't stay shut down forever. That would cause much worse problems than the virus. There is a number of new studies, new data points that suggest it's less bad than we were thinking. But as to how much we're able to deal with it, that's still a question. I don't know how long it's going to take or how we eventually will, but I know we will get through this and there will be a world on the other side. So now there's tons of people all over the place on TV, whatever, talking about what shape recovery we're going to have. Is it a V shape, L shape, Q shape, whatever shape? One thing I haven't seen anyone suggest is kind of what I initially lean towards in terms of if we're going to pick a letter, and that's a W, because I don't think it'll necessarily get worse than the point where everyone was very concerned. But if we need to be cautious because there may be setbacks along the way and we can't get too excited. And the one thing I wanted to say with people saying L-shaped recovery, it's going to be a disaster, whatever. L-shaped meaning basically there's no recovery, we just kind of trail off. Well, if you were to buy where the bend is in the L, like after the downside's in, I'm just wondering, and obviously we're a bit off that point, but what's your risk reward if you buy there? One interesting point that I want to clarify came up from when a friend called a few weeks ago and asked, is the recession canceled? He was making a joke, it was funny, about the Fed printing money to stimulate and buy, bonds and whatever. And the response was an explanation, probably more than he bargained for, um, about how that the market isn't the economy. The market is not the economy. It's a completely different thing. You can pump money into the market and support the market without necessarily helping the economy. That said, this time there were a number of support. There was some support to the economy too. That said, I'm just mentioning that here that the market isn't the economy because the market did tank before the jobs report hit the economy, before people were realizing how actually bad this was going to be. So it stands to reason that on the other side, whenever that is, the market will lead the economy out, meaning that once on the turn, when things begin to get better, stocks are probably going to look pretty expensive before. Which brings up the case for fundamentals. Now, I invest based on fundamentals. There's different people can do different things. Some people only do charts, some people do trends, some people do whatever. But for me, when I say fundamentals, I don't invest looking at price to earnings or forward price to earnings. That doesn't make sense. That's something that kind of everyone sees, and you can kind of look at it, and sometimes it's very misleading when things are changing. So fundamentals for me is looking at a company and looking at how much money they're going to make over a long term. So let me ask, why do companies trade at 5 times, 10 times, 15, 20, whatever it is of cash flow, earnings, whatever you want to use? Okay, now that you have your answer, if one year a company earns $0, does that mean that the company is worth zero? Because 10 times zero is zero. For me, the answer is no. For me, the answer is you got to look over time. So when we're looking at what the fundamentals are for this year, so if you're saying the S&P this year is going to earn whatever, and the forward price to earnings is, you know, higher than normal, it's like that doesn't really help because what are they going to earn next year and the 9 years after that? And so, yes, this year's not going to be good, obviously. So does that mean that stocks should go to zero for this year and then back to whatever times earnings next year? For me, I'd be a big buyer at zero. There have been a number of people and a number of concerns out there, and I've even spoken to a friend about it. People talking about the Great Depression Part 2 or deflation or whatever. And I just want to compare where we are now versus where we were then, because the Great Depression started and interest rates were 5.8%. Now they're zero. They were 5.8%. And in addition to that, there was 10% inflation that persistent 10% inflation. That means your money was getting more valuable by 10% per year. Plus, you can get risk-free rates of 5.8%. Later, it was 2.5%. Basically, you could get 15% in bonds. And people were getting paid huge amounts to not take any risk, not spend money, not invest. And the way I'm looking at it now, that's a different environment because every move since, by the way, to get out of the Great Depression, they devalued the currency. And every move since then, at every point of crisis from all the central banks, has always been to fight a repeat of the Great Depression, to not allow deflation. So I think that part of the fear of a Great Depression part two, part of the fear of deflation, is the thought that people are not going to want to spend money. And that's a fair point at a time like this. The one thing I will say is that everything we've seen since the Great Depression has shown that central banks, governments, whatever, more so are willing to blow up the currency by destroying the value rather than having the value go up. Just look at what's going on and look at all the money that's being spent to fight deflation right now. And I don't know how likely it is that we get any type of persistent deflation, because I think it's going to be fought with every dollar yet to be printed. The next piece of the puzzle is that there's too much debt, and there's too much debt everywhere. The government, the corporate, and the public sector all have too much debt, which means that if there's deflation, if there's persistent deflation, everyone's in a lot of trouble. And that's what makes people very concerned. That said, the government can create money, and the government can and has been stimulating both the corporate and the public. And the reason for it, and a lot of people, it's not necessarily right or fair that the government um, helps the corporate and the private sector to whatever degree that they do. But the thing is, we're stuck. We're stuck because if the government decided not to help the corporate sector, some of it's just wasted money. But some of the marginal corporate sector that without help might not go bankrupt. Well, what are they going to do to cut costs to try and survive? And the cutting costs could be the public sector. So the problem is it's not as simple as government bailing out companies bad or good. It's much more complicated than that, because the companies, some of them have been doing things that are very unfair to be bailed out. But at the same time, there's other companies that, well, they could survive by cutting many, many jobs. But the problem is that makes the whole thing worse. So we're stuck. And the answer, in my view, is that money gets spent. And so without making a judgment of if that's fair or unfair, if the money is being created to be spent, then that could be BS for many responsible people and responsible businesses and people who've played by the rules. But at the same time, there's a lot of people that don't care about that, because there's a lot of people that could be out of jobs. And if you look at how many people died in the Great Depression because not enough was done, then I'm thinking even less people are going to care about the people for which printing money would be BS for. Bad grammar, but anyway, I think you get it. And my point is, we're already seeing this. We've seen the rates go to zero overnight before the market even hit its bottom. Rates were at zero. Cash payments to people from the government, bailouts to certain corporations. They're getting equity this time, and hopefully they do it in a better way. But again, massive spending. And if we looked at this beforehand, if we looked at the government debt, we could see that they were never going to pay it off in real terms. They needed to inflate away a bit of it. But now with this much debt, the rates are just pinned at zero. Because any increase in rates is going to do a lot of damage to the government as well as all the sectors. So rates are kind of pinned here until we get inflation. I've wandered through this rabbit hole a bit, so I just want to clarify what these past few slides mean and what they don't mean. To me, what it means is that bondholders need to eventually be screwed. I'm not saying it's in the next 30 years, but at some point there needs to be more inflation than the yield on the bonds to inflate away the debt. And that happens, well, that could happen slowly or all at once. We never know. And until that happens, it means that the rates are pinned low and maybe zero, maybe negative, maybe slightly positive. Can't really know, but if it gets too high, then can't afford to pay it. Versus what this does not mean. It does not mean that we get out of control inflation. The quote that I believe best describes the situation that too much debt has led to is if you owe the bank $1 million, you have a problem. If you owe the bank $1 billion, they have a problem. The other quote that I think kind of encapsulates this video and is very important in times of extreme sentiment is from Benjamin Graham's book, The Intelligent Investor, where he says, the intelligent investor is a realist who sells to optimists and buys from pessimists. That's all for today. Thanks for watching, everyone. Remember, none of this is investment advice, and I'm definitely not saying you should run out and buy tons of things. I'm just saying next time you're too bullish, maybe stop and think. And next time you're too bearish, maybe stop and think. And with that, I will wish everyone a great weekend. And until next time, have a good one.